AQN, Algonquin Power and Utilities Corporation. It trades on the New York Stock Exchange and the Toronto Stock Exchange. Here, we're focusing on the New York listing, the American listing. So all focus will be on USD and the American prices. It's got earnings coming up. Earnings coming up later this week, 7th of November. Put it in your diary, 7th of November. It's at a 52-week low. In fact, it's at decade-long lows. So quite the misery there for long-term investors. But right now, there's possible opportunity here for dividend investors who eye up price appreciation. That two-hit combo, the two requirements, dividend and price appreciation. Firstly, let's talk about the dividend. The dividend yield is currently circa 5.2%. So that's a decent chunk. That's a decent dividend yield. That's based on the stock price as of now, $4.76. The dividend looks safe to me right now. That's largely due to it being right-sized a couple of times in recent times, including the most recent 40% reduction. Now, we appreciate it has been cut before and all the caveats that come with that. No one really needs to make mention of that. You can if you want, but completely understand it all, right? But we're talking about the here and now. The current price and the current dividend per quarter, in my view, looks very sustainable. Let me show you why. Last quarter, the earnings per share for this company, AQN, was 9 cents. And the estimated earnings per share for the next quarter, that's quarter 3, that's upcoming, that's 9 cents again. As long as they can maintain that, it's nice and comfortable because the dividend payment each quarter right now sits at 6.5 cents. Now you do the math. That's a payout ratio of 72%. It's well covered. Now, you may think 72% is on the high side. It's not really on the high side for a utilities company. The average payout ratio in 2020 for utility companies was 67%. So it's pretty much an average payout ratio in this sector. As an FYI, the Algonquin payout ratio is actually expected to drop as earnings stabilise and increase due to increased demand, reduced maintenance spend and rate case reviews. Rate case reviews, very important, and obviously they're in the pipeline. Some have already been applied earlier this year, and there's future rate case reviews coming up. But we'll get on to those in a few moments' time. Before we do move on to possible earnings increases and price appreciation, let's recap. Let's make sure you understand what AQN is. AQN is now a pure play regulated utility company after agreeing a definitive sell agreement in August earlier this year, 2024, of its renewable assets. The systems it covers are electricity, water and gas. It's got 1.2 million customers across the US, Canada and Chile. That's in South America, Chile. With this comes high-quality assets that AQN owned by AQN, thousands of kilometres of electricity transmission, water mains and gas pipelines. The market cap is currently $3.65 billion with a share price of $4.76 right now. The company has $9 billion in debt. With the sale of the renewables for over $2 billion, the balance sheet will be bolstered and more debt can be paid off. As for the debt, it's not a great deal that some may make it out to be initially. It's common for utility companies to carry debt. It gets spread across long-term maturities and AQN can refinance as interest rates drop into 2025, as well as pay off more debt due to dividend reductions, increased earnings and reduced maintenance spend. So basically, chipping away at the debt, which ultimately helps unlock long-term shareholder value. Fundamentally, with dividend stocks, what I try to do is I try to invest with tailwinds in mind. There's a few for utility companies in general. Lower interest rate environments as the Fed reduces rates. That's going to help AQN refinance its debt at reduced interest rates, so helping the company save money long term. Migration. Now, we've seen it all in the news. We all know about it. It's increasing in Europe and North America. We know it. Let's not talk about the politics behind it. But it is increasing in the US and Canada as well, which means more customers to serve. We've got secular trends such as AI, artificial intelligence, and electrification of transport, both of which are energy thirsty. Lastly, you got rate cases, and this is especially for Algonquin, AQN. AQN has been very active in filing rate cases. We'll get on to that in a moment. Let's just look at the strategy of the company. The strategy, it's transitioned into a pure play regulated utility company as part of its aim to provide long-term value to shareholders. The transition, that was the initial step. Now, there's two subsequent key steps that Algonquin is trying to take, or is taking rather, to increase value for us investors. Firstly, this is the first of these subsequent steps, focus on reduction. So this buzz term, capital-light growth, that's achieved by restraining regulatory expenditure to slightly above maintenance levels. So basically, it just means reducing spend. The company's not spending as much. And secondly, and this is key, it's key that we understand what's going on here. Rate case review filings. These are formal processes to determine the amount per unit a customer should be charged. Quite often, they're done when the cost to provide exceeds what the customer is actually paying. AQN has had a very, very, very busy year. A busy 2024. In fact, it's the busiest in the company's history in relation to rate case filings. So it's been very active in submitting these filings, and some of these are already in the works now. They've been accepted and they are being reflected on the balance sheet. In fact, it's been reflected in quarter two. So if you did have a look at quarter two, I'm sure if you check the Q2 report, you'll notice there was a year-on-year 6% increase in divisional operation profit, and that was driven by new rate implementation. In addition, there are further rate review filings that the company is looking to submit. This all falls into share price appreciation potential. The current share price is below $5 US. Point of interest for me is the book value. So right now, the share price 4.7-ish, okay, 4.76 if you want to be exact. Now, the book value is sitting at 9.35 per share, so 9.35 US. That's quite a discount from book value. That's roughly a 50% discount. As for analyst price targets, obviously you can take these with a pinch of salt. The high is 7.5%. I beg your pardon, 7.5 US. The upside potential, if you do the figures, you're looking at 58% upside potential from current levels. The average price target, the average analyst price target that is, that's sitting at 6.23 US. That means the upside potential is roughly 30%. Now, I'm a buyer at this level. Obviously, this is not financial advice for you. This video is made for entertainment purposes. As for the technical analysis, long-term support may have been breached technically. Now, when it comes to short-term analysis, it could go lower this month. Could go into the 4.5s or low 4s. Now, obviously, that represents a better buying opportunity if you're a bull, right? If you're looking to accumulate shares. At this current price level, it's attractive. At lower price levels, it's even more attractive. So it could just get more and more attractive provided there's no nasty surprises or write-downs in the earnings call later on this week. and obviously we'll be keeping you updated on that. Don't forget to like and subscribe. Thanks for watching.